We've avoided recession that a lot of people were expecting, and that's caused a shift in the markets. The biggest of which has been that stocks have outperformed bonds by a very wide margin, and that the economy and the stock market have managed to hold up despite aggressive rate hikes by the Federal Reserve, which I think is really what has caught a lot of people off guard and by surprise. They assumed that rate hikes of this magnitude would, crash the economy, crash earnings, and crash the market, and that hasn't happened.
Welcome to Soar Financially. Thank you so much for joining us here, where we discuss the macro to understand the micro. The micro being for us, the mining stocks and commodities, of course, because the sentiment is so bleak. So we're trying to make some sense of why that is. I've invited a fantastic guest on the program today. It's Sam Burns. He's the chief strategist over at Mill Street Research. And we are going to talk commodities, but also macro, meaning the markets, like what is happening primarily in the US. It's still the number one in the world in terms of market. We have to take a look at it. Is there a recession looming? Are we in a recession? Is there even a recession on the horizon, if at all? So, and we're trying to draw some historical comparable or comparisons as well. Like, what can we look for, or does history teach us anything? That's the idea here. Trying to go through that and do some forecasting as well. I warned him I'm going to ask him about Q3 GDP expectations, but also we'll have the quarterly report season just around the corner. Costco already put out some numbers, so I'm curious to learn more about what he expects to happen or to see from the quarterly financials, especially the big box retailers that I'm interested in, because they're giving you a bit of a foreshadowing of the economic situation. Before I switch over, real quick reminder, hit that subscribe button. 80 to 85% of you watching are not subscribed. Let's change that so we can bring guests like Sam on more frequently and get other guests of great caliber on as well. Thank you so much. Now, Sam, welcome to the program. It's great to have you on, and welcome first time on Soar Financially.
This is great. Thank you for having me on.
Absolutely. Yeah, really looking forward to the next 25, 30 minutes here with you, Sam, because as we just chatted briefly off camera here, we've got lots to chew through, lots going on in the markets. And to set the scene a little bit, Sam, why don't you give us a bit of an explanation how you see the market right now? What's the current state of the economy?
Yeah, well, it's definitely been a confusing couple of years here, and my view is that the economy the U.S. economy, I should say, has held up a lot better than most people expected. Certainly, late last year, coming into early this year, I think the sentiment toward the economic outlook, inflation, and corporate earnings were all very, very negative and bleak coming into this year. And I think that the results have been better than expected. Not that they've been spectacular, but simply they've been better than expected. We've avoided recession that a lot of people were expecting, and that's caused a shift in the markets. The biggest of which has been that stocks have outperformed bonds by a very wide margin, and that the economy and the stock market have managed to hold up despite aggressive rate hikes by the Federal Reserve, which I think is really what has caught a lot of people off guard and by surprise. They assumed that rate hikes of this magnitude would, crash the economy, crash earnings, and crash the market, and that hasn't happened. And I think the offsetting factor to this cycle has been fiscal policy in the U.S. That we've not only had the stimulus after COVID, but we've had another round of infrastructure and kind of longer term kind of stimulus from Infrastructure CHIPS Act, things like that, and that's really been the deciding factor for this cycle relative to a lot of previous cycles, in that you have not had fiscal and monetary policy tightening at the same time. You've had fiscal policy being supportive while monetary policy has been tightening, and they've in some ways balanced each other out. That's not been true so much outside of the U.S., but that's been the major story here in the U.S. from my point of view.
Absolutely. You mentioned we avoided a recession. I need to follow up on that. Took note of that. Have we completely avoided it? That soft landing scenario that the Fed sort of signaled, and even no landing scenario, is that actually fact? Is that true?
I think certainly so far. I think, given what I heard from a lot of people at the beginning of the year, we should be in recession right now if those forecasts were coming true, and we're not. In fact, growth is actually picking up some from where it was in the first and second quarters in terms of GDP and kind of overall economic activity. And so that tells me that there's still enough momentum in the economy to keep us away from recession, and probably for at least another couple of quarters. So to me, and also looking at what corporate earnings are doing, corporate earnings have been better than expected for the last 2 quarters for sure, and may do so again here in the third quarter. So that tells me that a lot of the kind of sentiment was quite negative, but was, and as it turned out, too negative. And that was actually even true for the Fed. The Fed had been predicting a recession earlier this year and has now revised that to not predict a recession, and have adjusted their sort of rate forecasts accordingly as well. So I think a lot of people, including some of the policymakers, were looking for things to turn out worse than they have in retrospect. And I think, again, it's the mix of policy that's come through, along with kind of special factors like the invasion of Ukraine and China's movements and things like that have thrown off kind of the traditional interpretation of the data that people typically have from past cycles.
One thing that's puzzling me a little bit, and maybe you can make some sense of that, is like the GDP growth of 2.2% last quarter, which was a bit of a surprise, I think, to almost everybody, because it's the strongest GDP number we've seen in all of the G7, G8. So I'm really curious what's behind that. I think you've done some analysis on that.
That's right. Yeah, it has been stronger than expected and better than most of the other developed countries. And again, I come back to the fact that U.S. fiscal policy has been much more stimulative and supportive in a good way than most other policies in other countries have. It's been because you had not only, I say, that sort of the lagged effects of the COVID stimulus, where money was sent directly to households and all the different things that came along with that. Once, even after that ended, you had the sort of second round of the infrastructure-related, technology-related, Inflation Reduction Act, all those things that have put money into sort of manufacturing growth and things like that are both driving job growth, employment growth, wage growth. That's helped the economy, but also increased the productive capacity of the economy. We can make more things now, and that's helped bring inflation down to some degree. I think will continue to do so, which again hasn't happened in the rest of the world. And of course, the U.S. has more of its own domestic energy supply than, say, Europe does, for instance. And that's helped bring inflation down and keep growth up in a way that is not applicable to some other markets. So I think there's things that are special to the U.S., both in terms of policy and in terms of things like energy. And those have helped the economy hold up despite higher rates. And the impact of higher rates will be felt and is being felt, but it isn't an immediate sort of crash of the economy. It's more of a slow grind lower in terms of influence on mortgages and housing and autos and things like that.
It seems like I hate using that term, it's a rolling recession, because I don't think anybody really knows what that means. But you sort of hinted it, like there are certain areas and sectors that are hurting more than others. Because I remember the Q2 GDP numbers have been propped up by auto sales, or like the auto industry, just because of additional production. There were some special effects in there. I'm not the expert on that, but I read that somewhere, that the auto industry was partially to blame for the strong GDP numbers, while housing on the other end is suffering, right? We're seeing like a 15% drop in home sales, things like that, extremely high mortgages. Are we going to see more of a bifurcation in that regard?
We might, yeah. It's definitely been a very sort of disjointed trend, and again, a lot of that has lagged effects from COVID, including the auto industry, where the production of autos was severely constrained for several years due to chip shortages and everything else. And so there was a sort of a catch-up effect in terms of auto production that we've seen this year, as automakers have been able to resume more normal levels of pre-COVID levels of production, and that's been a boost to the overall economic activity. And again, you've got things like the Infrastructure Act that's really driven a lot of manufacturing related growth. The amount of construction spending and manufacturing has like doubled in, I think, the last 16 or 18 months, almost directly because of all the electric vehicle and battery plants and all those kind of things that are being built now, either directly because of government support or because of private sector responding to incentives in that regard. And so you've seen some areas like that have been very strong, whereas other areas have struggled a little bit more. And so to me, it's definitely a sort of a disjointed activity level, but it is net still positive and still better than expected. And even in housing, you've seen the number of home sales has collapsed. People just aren't buying and selling homes, existing homes, but the number of new homes being built has actually held up pretty well. And particularly in multifamily and apartments and things like that, there's been a very sharp rise in construction. So home builders are actually doing quite well, which has been a big shock to a lot of people because they assumed that a 7+ % mortgage rate would crush demand for housing. But so far, you've had people not wanting to sell their houses if they still have a low rate mortgage. And so they're keeping supply off the market. So if you can't buy an existing home because there's not many for sale, you go buy a new home, a newly built home, and that's kept demand for new homes up and kept the home builders busy. So it's very sort of counterintuitive to see, mortgage rates go up, but then the home builders still building lots and selling lots of houses. And I think it's because they went up so fast, the mortgage market and the housing market has been almost frozen. And so the money goes somewhere. And so it's right now going into new housing and not existing housing. So a lot of these things are very unusual cycles historically. And you've seen these big divergences within industries and across industries. They're going to continue for a little while longer. But eventually, housing activity will slow down and people will get used to the sort of the higher mortgage rates. But that may take a while.
I want to talk history in a second as well, but I got to ask you about some short-term effects that might be sort of weighing on the markets here within the next 7 days, actually. One is the UAW's, the striker, the action in the auto industry, with probably going to hit the big three companies there quite a bit. Student loan repayments are going to start this Sunday. Actually, the day we're going to air this interview, wondering what the impact of that is. And we also have a potential shutdown looming in the US. That topic is not off the table yet, although it seems solvable. But curious what your your guidance in that regard is. What do you see any effects from any of these three?
Certainly in the short run, yes. I think certainly the UAW strike will hurt production, auto production and sales for a little while, depending on how long it goes on. And the same thing with the government shutdown. Historically, they've tended to not have a big long-term macro impact, but in the short run, it certainly makes life difficult. A lot of the money that would normally be spent when the government's open will get spent later. But there are going to be some things that don't get done. And again, that's the risk to the economy from my standpoint is almost more of policy mistakes than anything else. I think one of the things that's maybe likely to prevent the Fed, for instance, from raising rates any further than they already have are these sort of uncertainties from labor actions, government shutdowns, and the fact that they may be missing some of the data that the inflation data or GDP data, things like that the government produces. May not get produced if the government shuts down for more than a couple of days. So there's a lot of reasons why to be cautious about taking big policy steps, certainly from a monetary policy standpoint. I think that'll keep the Fed a little more on the sidelines. But overall, those are headwinds, and certainly student loan repayments will hurt kind of consumer demand to some degree as money gets shifted toward that where it hasn't been for the last few years.
Yeah, I'm really curious what that impact is because people have been or the government has been pushing that back and back further. Now it is looming on Sunday. Really curious. I've just Googled it. It's like I'm not even sure how much is owed to a degree, like how much actually has to be repaid on day one and what the terms are. Depends a bit, I think, on the loan service providers. But really, really interesting. Something to watch most definitely as discretionary spending. We're already seeing a bit of a dip there, in my opinion, and Costco sort of confirmed that just this week by when they put out their quarterly numbers, saying, well, grocery sales are up, but we see a drop in discretionary spending. So, to come back to corporate earnings that you had mentioned, what do you expect to see for Q3? Do you see more of the same?
Yeah, I mean, when I'm looking at what the analysts are doing with their earnings estimates, which is often a pretty good kind of proxy for whether there's likely to be a lot of big positive surprises or negative surprises or more or less in line. In the last couple of quarters, we've seen analysts raise their numbers after the quarter when they got surprised to the upside, and so I think they've come into this quarter a little bit more positive than they have in previous quarters. So you might not see as many big upside surprises, but I don't see them cutting estimates going into the quarter, which is often a clue that the earnings are likely to disappoint. And that's true both at the company level and in sort of the aggregate level. So my guess is that we won't see any big negative surprises from corporate earnings, and you might still see some positive surprises coming in from some areas. But I think it'll be more of a mixed bag, and that it won't be sort of the positive shock that we saw in the first and second quarter earnings. as now analysts have kind of adjusted to it, and some of that momentum has slowed down a bit as the impacts of some of these things we've just been discussing are going to show up in the corporate earnings. So I think there'll be winners and losers, but I don't think it'll be a big shock either way. So I think earnings are generally going to be decent for this year and look like they'll still grow pretty well next year. So it's almost that you would expect analysts to be cutting their estimates right now if you were seeing a recession or you're seeing bad news come through, and you're not. So in the sense of a dog that didn't bark, I think that's what we're seeing right now, is that I think things are sort of still okay because otherwise we would probably be seeing more negative activity from the analysts.
Just made me think of somebody, if you want to enter a home, you actually bring a sausage with you so the dog doesn't bark, right? So I'm trying to figure out the fiscal, like the Infrastructure Act and the CHIPS Act, is whether that's the sausage or not, right? Trying to figure that just in terms of euphemisms, right? But is there anything in particular you're watching when you look at the Q3 numbers? Is there anything you're paying attention to? I mentioned discretionary spending at the big box retailers like the Walmarts, the Costco's, Sam's Clubs, right? So I'm curious if there's something you're paying attention to.
That's right. Yeah. So some of those areas are going to be where you see the impact of, wage growth and job growth, because that's where, the sort of middle and lower income spending is much more driven by, wage growth and whether people have jobs, whether they're getting raises, as opposed to say what the housing market or the stock market is doing and things like that. And so I think that's where you'll see that spending is probably in aggregate holding up okay, but what people are deciding to spend money on may be shifting. And certainly we saw that, coming out of COVID, there was a lot of, good spending. People had to stay home and buy things and couldn't go out and do services. And then in the last year or so, it's been much more services, people going out and, traveling, hotels, restaurants, leisure, Taylor Swift concerts, all those things have been where people have been spending money, and less so on, goods off the shelf at the grocery store. And so I think there's still that sort of rebalancing going on within spending. That's, again, very much the opposite of what normally happens in a traditional cycle. Usually in a recession, people continue to buy services but stop buying goods as much. And in COVID, it was the other way around. And so now we've seen the reverse of that, kind of a lagged effect as people rebalance their spending. But there's still money there to be spent, I think, is the key thing. And that some of it is going to have to go to higher mortgage payments, and some of it, even just in the last month or so, going to have to go to, say, fuel costs and energy costs. But I think overall the spending will hold up. But I think you'll see some of it being diverted away from kind of more discretionary fun things to more necessities, which may show up in the data as well.
Yeah, I'm really looking forward to seeing that as well, or not just looking forward to it, but I'm curious to analyze the quarterlies and you get some hints of where things might be heading, right? So one thing I want to discuss with you, Sam, and I brought it up on the screen, is the Bloomberg commodity indices. You just put that out actually on Twitter like an hour ago, and I think it's really, really fitting for the theme of our channel and something really worth discussing. And it's the Bloomberg Commodity Index versus the Bloomberg Commodity Index ex petroleum. And one thing you've mentioned is that you don't really see a recession right now. But if I look at the commodity index ex petroleum, like it keeps dropping and going lower, heading into something. Actually, into what? Into what are we heading? That's the question. Why is the commodity index so much lower? Gold has been hanging in there, but the base metals are struggling. You want to elaborate on that?
Sure. Yeah. And again, it's another case where there's a divergence going on that's sort of unusual. And then you've got oil prices going up recently, almost exclusively due to OPEC's and Russia's supply cuts, where they've intentionally restricted supply to push the price up. And after several tries where it didn't work, they now have managed to get that to work. They've cut supplies enough to push up the price of oil, but basically the price of everything else, including things like natural gas, but base metals, a lot of other things have not gone up. And so that's why you're seeing that very wide divergence, where before you saw the ex petroleum and the overall index moving much more closely together. You've seen that divergence widening because most commodities are not going up and in fact are still falling. And to me, that's partly an indication that inflation globally is not likely to be a real problem outside of just the impact of oil. So central banks probably don't have as much to worry about, that the underlying sort of inflation pressure is still slowing. And that's why I expect, reported inflation to continue to kind of gradually slow down, and that you shouldn't see much more in the way of policy tightening, certainly in the U.S. But it also tells me that the impact of China's weakness is much more visible now than it has been in past cycles. And my view is that a lot of commodities are probably going to stay under pressure unless there's a supply shock like OPEC or something else. That the demand that had previously come from China for the last 20 or 30 years has been sort of a general support for many commodities, including a lot of base metals and things like that, just really isn't going to be there, that they're not going to be able to do the kind of stimulus and large demand for commodities that they have in the past. And that's really what we're seeing here, is that global demand, and particularly from China, is relatively weak for a lot of those things. And that while the U.S. has some support from things from the stimulus, the rest of the world doesn't really have that, and that there's not really a shortage of most commodities, again, unless it's sort of an engineered shortage driven by either a war or conscious political decisions by OPEC. And so that tells me that it's only kind of contrived supply shortages that are really driving things in the broad sense, rather than overall inflationary pressures or demand.
Talking about demand, I'm curious, and I have to ask you. You can tell me off. Actually, like I'm curious. As like, how do you forecast, or like what's your forecast going forward? Let's say for the next 6 months. I think anything beyond that is dreaming, and is very difficult to predict, in my opinion, because there are so many moving parts. But for the next 6 months, let's look at base metals in particular, and maybe oil and gas. But what do you forecast?
Yeah, I mean, my general view has been that commodities, as a whole, will stay sort of under pressure. I mean, there's not going to be any really big move to the upside in most commodities. And again, I think that's partly China and partly the sort of slowing, the tightening monetary policy in a lot of the developed world, and the lack of dramatic fiscal support most places outside of the U.S. and even probably fading here in the U.S. So I don't see a big demand driver for commodities in general. And unless, again, there's a supply shock of some kind, I don't see that being the driver. So OPEC really stands out as kind of the diverging factor, where they're trying to push oil prices up and have succeeded recently. But overall, I think that the pressure is going to be to the downside. So I've been kind of underweight the commodity space in general and equities, just because I don't see there's really a 6 to 12 month positive view there. There are going to be some tactical opportunities like we've seen in oil potentially, but the fact that oil is up and natural gas is not, because there's no cartel for natural gas, that there's still plenty of it to go around, and that the general long-term shift away from fossil fuels, I think, are all kind of factors that argue against a big upswing in commodities in general, and that it's only going to be specific things that narrow kind of areas within commodities that might have spikes to the upside.
Interesting. Really curious. Like trying to, because the EV revolution, everybody paints a picture. We need a lot more copper, but I don't see it in the numbers. Like, and
yeah, there's plenty of copper around. I mean, there's more mining going on in China and a lot of other places in the world. There isn't a shortage so far. And so if some of those projections come to light, then yeah, there might be a shortage at some point. But they just found a whole bunch of new lithium, I think, here in the U.S. Recently, and so there's a lot of areas where it turns out there is enough to go around. There's supply that can be found and dug up if if the price is right and if people are looking for it. So I think there's a tendency to assume that whatever supplies are there are fixed. But in some cases, over a year or two, there can be new supplies found, and even oil and gas production in the U.S. has risen back up to near its highs as a result of the kind of boost in prices lately. So there is supply to meet demand to some degree in the longer term, and so you're only going to get these shorter term spikes when supply suddenly kind of has a shock.
We have to talk gold and silver as well. We primarily talk base metals, oil and gas. I'm curious what your price forecast or your gut tells you about the precious metals here.
Sure, and certainly precious metals, behave differently than a lot of the kind of other commodities that get used in the economy as a practical use. And there, my kind of macro view on that tends to be, real interest rates and the dollar have a big influence on the direction of gold and silver, the precious metals. And the rising real rates and rising U.S. dollar tend to be negative headwinds for gold and silver, and that's certainly what we've seen the last couple of months, as real rates have been shooting higher in the U.S. And the dollar has been stronger, which tend to reinforce each other sometimes. That's been a headwind for precious metals, but certainly earlier, in the last year or two, when we saw certainly a drop in real rates in 2020 and a weaker dollar. Then you saw the big move up in gold and silver. And so to me, your view on gold and silver and precious metals has to somehow tie to your view on real interest rates and the US dollar. If you think they're going to keep going higher, you probably want to avoid precious metals for now over the next few months. If you think there's a chance that they'll break lower, then you have a good reason to want to get more involved there. So right now, I'm not seeing a big strong buy signal for precious metals based on those macro factors, or even on the earnings estimates that I see in the analysts who track gold stocks or mining stocks. They're still relatively cautious. So tactically, I would probably stay more on the sidelines. But once real rates really break, they start to plateau and turn lower. Then I think you'd see the tailwinds for precious metals come back. And so in that way, they're in some ways a good hedge. If you're losing money on your bond portfolio because real rates are rising, then you can think about precious metals in that way. But I think they'll have a lot better chance of outperforming if once real rates kind of peak and turn lower.
Fantastic. Sam, what is one of the sectors you're extremely bullish on right now? Like, because we all, like, a lot of our listeners are obviously long-term investor or long investors, usually not short. So there's got to be a bullish scenario out there somewhere. And where is it?
Well, certainly, I think in the U.S., technology still looks pretty good in the sense that when I look at where the earnings trends are the most favorable, certainly a lot of these services and software type companies, anything to do with AI, those all still have pretty solid support. Now, some of them have gotten ahead of themselves on a valuation basis, so they would be sort of buy on a pullback type areas. And then some of the areas that are still benefiting from the stimulus, industrials type areas that have that support from manufacturing related construction, those still have, I think, some tailwinds for a while longer. Some parts of the consumer area, I think, have relative strength. Some may wobble a little bit here, but those are kind of the areas of relative strength that I'm seeing over, say, the commodity areas or areas like healthcare or utilities and things right now. So, to my mind, some of those areas that have sort of more secular prospects or that have a longer term theme of fiscal support are probably areas to look at still here in the U.S.
Fantastic. Sort of the last question, Sam, here, and I mentioned it in the intro. I want to draw some historical comparisons as well. Is there anything or any time in the past that we can compare to today? Because it seems like a lot of the experts are having a tough time coming up with the right time frame to look at. Yeah, a lot of people quote just the late 70s with Arthur Burns and Paul Volcker in that current scenario. But it's completely different, though. There's like little pieces that would fit, but overall is very difficult. Like, what's your assessment there? What do you think?
Yeah, you're right. There's been a lot of different comparisons, and certainly I've heard a lot of the ones about the 70s and early 80s. In my mind, we're not really in the sort of 70s, persistent inflation scenario. There were a lot of factors then that drove that, including oil embargoes, bad harvests, monetary policy, Vietnam, going off the gold standard. A lot of things happened then that are not happening now and not going to happen. To my mind, it's almost more like the post-World War II scenario, the late 40s, early 50s, when you had a big shock from the war that constrained production and rerouted the economy in a lot of ways. And that then once it was sort of released and things kind of went back to normal, people came back from the war, all the rationing and everything came loose. You had a burst of inflation for a couple of years in the early 50s. And then things settled down as supply basically came back online for domestic production, not wartime production. And so you had a big burst of inflation. You had, basically the workforce and the economy had to be reorganized toward, in that case, the war. And in this case, it would have been COVID. And now that that's reversing and we're going back to more sort of normal scenarios, the inflation comes back down, supply kind of comes back online, and policy can readjust to that. So in that case, they had, interest rates were suppressed for quite a while and then, had to readjust higher. That's what we're seeing now. But I don't see the kind of, decade-long inflation and the rise in interest rates to double digits that we saw in the 70s and early 80s. Because the demographics are different, the underlying drivers of the economy and inflation are different, and I don't see the unusual combination of factors that drove that recurring here. Again, shocks can happen. If there's more wars break out or more pandemics or things like that, then who knows. But in my mind, if we avoid any major shocks like that, there is enough kind of, I think, economic activity and policy support to get us back to sort of what I consider more normal kind of pre-COVID activity levels. And I think the demographics are such that you won't have that pressure on the longer term trends in inflation and output.
Very, very last question, Sam. Is the Fed done raising rates?
I think it is. I think they're going to continue to kind of keep their hawkish messaging. They're not going to say they're done because they want to keep that door open. But I think that they realize that they've done a lot. That the banking system and the credit markets and mortgage and everything have been constrained, which is what they can do. I think inflation is coming down. I think over the next few months we'll see that even more clearly. And so I don't think they feel like there's much more they can do. They can't really do much about OPEC and oil prices, and they know that. But I think they want to make sure that people don't see them declaring victory and saying mission accomplished just yet, because the reported inflation is still sort of elevated. So I think they'll keep the hawkish messaging going for a while longer, but I don't think they'll actually hike rates any further than they have.
Sam, wonderful conversation. I really appreciate the insights and your time, obviously committed to this interview. Where can we find more of you?
Sure. So certainly Twitter, as you mentioned, post there under Mill Street Research pretty often. Also on LinkedIn, posting comments and appearances there. millstreetresearch.com is the website. There's examples of the research there. There's a blog that I update once in a while there as well. So you certainly can reach out there. There's a contact form if anyone wants to reach out and find out more.
Fantastic. Sam, thank you so much for your time, and to everybody else, thank you so much for tuning in to Soar Financially. If you haven't done so, hit that subscribe button. We really, really appreciate it. Leave a comment below as well. Engage with us. What do you think is going to happen in the next 3 to 6 months? Are we heading into a recession? How bad is it going to be? Or how positive is it going to be? Is the market going to rally? We had a guest on yesterday that said, well, the market is there's going to be a massive melt up in the markets before it crashes. Well, is that something you're looking at? So I'm really curious to hear from you. And please share the video with like-minded investors as well. We appreciate that. It helps us bring guests like Sam on more regularly and guests of other great caliber as well. Thank you so much for tuning in. We'll be back with lots more.